Okay, so you sent us a ton of stuff about the different ways um, a business can actually be owned.
Yeah.
It's a bit of a jungle out there, right?
It is. It is. There's a lot to think about.
So what we're going to try and do today is sort of like boil it down to the essentials and give you like a really clear picture of, what are these basic legal structures, right?
Yeah, absolutely. We're going to look at the core decisions that people make when they're setting up a business, and all the way from people working on their own all the way up to multinational corporations.
Right.
And you've given us a great range of sources here, from like straightforward educational stuff right through to some like pretty in-depth articles. So yeah, we've got a lot to go on.
Yeah. So think of this as like us dissecting the DNA of a business and specifically the legal framework. So like, how is this thing put together? What's the scaffolding?
Yeah.
So the main types that we're going to be looking at today are the sole trader, the partnership, the private limited company, which is also known as an Ltd, the public limited company, or PLC, and then finally organizations that actually have a main mission, which is kind of beyond making profit, which is the not-for-profits.
Yeah, a really good spread.
Yeah. So let's start with kind of the simplest structure, which is the sole trader.
Yeah. A sole trader, as the name kind of implies, is a business that's owned and run by just one person.
Right.
And it's the most sort of direct form of business ownership, and often the starting point for a lot of entrepreneurial ventures.
Right.
You might also hear it called a sole proprietor, or if it's a professional offering a service, it might be called a sole practitioner.
Okay.
And I think the really crucial thing to grasp from the outset with sole traders is this concept of unlimited liability.
Unlimited liability. That sounds kind of heavy.
It is, yeah, it is potentially.
Can you unpack that a bit?
Yeah, sure. It basically means that there's no legal separation between the owner, the individual owner, and their business.
Okay.
So if the business incurs debts, then the owner is personally liable for those.
Oh, okay.
Which means that their personal asset, their house, their car, their savings, could be at risk if things go badly wrong.
So it's all on the line.
Potentially, yeah. And that lack of separation is also why we often say that a sole trader is kind of unincorporated.
So the person and the business are kind of legally considered the same thing.
That's right.
Right. Well, there must be some upsides to this, right? Why would anyone choose to be a sole trader?
Oh, definitely. There are. There are. I mean, first off, setting up as a sole trader is normally really straightforward.
Okay.
Very inexpensive, minimal kind of legal formalities involved.
Right.
You also have complete autonomy. You make all the decisions. You don't need to consult with anyone else.
Right.
You keep all the profits.
Okay.
And that's, pretty directly rewarding. Your business affairs are private. Nobody else can see them. And generally, the tax arrangements are fairly simple. Often, you're just reporting on your own personal tax return.
Right.
So that ease of setup and, the direct benefit of kind of keeping all the earnings, that makes it a really popular first step for people, particularly for new entrepreneurs.
Makes sense. Yeah, very low barriers to entry. You're in charge. You're the captain of your own ship. But we've already sort of touched on the big one, right? Which is that unlimited liability.
Yeah.
So are there other downsides that someone needs to kind of be aware of?
Yeah, there are definitely other things to consider, as well as that significant personal financial exposure. Sole traders can often find it hard to raise large amounts of funding, if they want to kind of grow the business quickly. Lenders might see them as more risky, frankly, than a more formally structured company.
Sure.
If you get ill or need to take time off, there's nobody to cover for you.
Oh.
So that can be a problem. And, you're responsible for every aspect in the business, strategy, sales, admin, and that can lead to a very heavy workload. And maybe you don't have specialist skills in all the areas.
Makes sense.
And then finally, some people say that, operating as a sole trader can kind of, sometimes be perceived as a bit less credible, perhaps, than a limited company.
Oh, right. Okay.
And that might make it difficult to kind of attract certain types of clients or win certain contracts.
Right. So it's that trade-off between simplicity and direct reward on the one hand, and then kind of, personal risk and maybe some limitations on the other.
Yeah, exactly.
Where do we typically see sole traders in the UK?
Well, you see them across a lot of sectors, particularly where maybe the initial investment required is quite low,
Okay.
and also where there's a high value placed on personal touch, you know?
Yeah, yeah.
So think of things like your local taxi driver, a hairdresser running their own small salon, a freelance tutor offering one-on-one sessions,
Right.
maybe somebody providing handyman or gardening services locally. These are businesses where often the owner's direct involvement and kind of their personalized service, those are seen as real assets.
Right. Okay, that makes sense. So that's the sort of solo operator.
Yeah.
What happens if, more than one person wants to kind of, pool their resources and their expertise and so on?
Yeah.
That's where we get to partnership.
Yeah, exactly. A partnership is formed when two or more individuals agree to kind of join together to own and run a business together.
Right.
They share responsibility for running it. They share the profits,
Okay.
but they also share in any losses as well. And while setting up a partnership can often be done with relatively few kind of initial legal hurdles, it is generally considered a good idea to create a deed of partnership.
Okay. So what is a deed of partnership?
Well, it's basically like the founding agreement for the partnership. Like a partnership constitution. So it's a legal document. It outlines each partner's rights and obligations, how much capital each partner is putting in, how they're going to share profits and losses, and how to proceed if, a partner wants to leave or the partners decide to dissolve the business. And crucially, just like with sole traders, in a general partnership, there's unlimited liability.
Okay. So you are sharing the workload. You might be sharing some of the investment, but you're also sharing the risk,
That's right.
right? So each partner could be held liable for, for the actions of the other partners.
Yeah, you're collectively responsible for, both the good things and the bad things that happen in the business.
I see. Okay. Well, there must be some pretty compelling advantages to forming a partnership, though, right?
Yeah. Oh, definitely. Definitely. I mean, sharing, those responsibilities and the day-to-day decision making, can really reduce the burden on each individual partner. And obviously with more partners, there's the potential for, a larger initial injection of capital into the business.
Right. And you get that kind of wider pool of skills and knowledge and experience.
Exactly. Yeah. You might have one partner who's fantastic at marketing and sales and another one who's really got a strong financial background.
Right.
And that kind of diversity can, give the business a more rounded approach and make it more robust.
Yeah, makes sense. And as we said, generally the shut-up's less complex than forming a company.
Yeah.
And you get that, you retain that kind of privacy.
You do. And, that pooling of resources and those complementary skill sets often make partnerships kind of a natural fit for professional service firms.
Right. So like the examples we talked about earlier, law firms, accountancy practices, medical groups, often.
Exactly.
Okay. So you're gaining strength through kind of collaboration, shared expertise, but you're introducing all this complexity as well of kind of shared responsibility
Yes, right.
and potential kind of interpersonal dynamics as well.
Yeah, definitely.
And you're still operating into that unlimited liability. So let's move on to a structure that offers kind of a different type of protection, which is the private limited company, the Ltd.
Yeah.
And this is where sort of this principle of limited liability becomes super important, right?
It does. Yeah, it does. Forming a private limited company, it really represents a pretty significant step, towards a more kind of formal legal structure for the business.
Right.
So the company becomes a separate legal entity, distinct from its owners, who we call shareholders.
Right.
And as you say, those shareholders benefit from what we call limited liability.
Okay. So some protection at last.
Exactly.
So how does that safeguard work? Like practically, what does it mean?
Okay, well, it means that the financial liability of the shareholders is limited to the amount of capital they've invested in the company.
Okay.
So their personal assets are protected from the company's debts and obligations, beyond their initial investment. It's legally separate, the company's finances and the liabilities from the personal finances of the owners.
Okay.
And it's also important to note that shares in a private limited company are not offered to the general public. They're sold privately and often require the agreement of the existing shareholders.
Okay. Right. So that protection of personal wealth is a huge plus.
It is, yeah.
What are the other benefits of being an LTD?
Well, by being a limited company, you can often kind of open up more avenues for raising finance. So, you can raise capital by selling shares to family members or friends or other private investors.
Right.
And you often also kind of gain access to a broader range of expertise
Right.
through your directors and shareholders. And often there's a perception that operating as an LTD kind of carries more prestige than being a sole trader or a
Yeah.
partnership.
Right.
And that can be good for your business's image and credibility.
Yeah.
And then another important point is continuity of the business.
Right.
So the company can survive legally, even if there are changes in ownership or management.
Right.
So this structure, we see this being particularly attractive for businesses that involve a high level of risk, or require substantial investment.
Right.
Precisely because of that limited liability thing.
Okay. So, yeah, it sounds like you're getting a much more kind of, robust and secure kind of foundation for your business.
Yeah.
There must be some trade-offs involved, though, right? To get this protection, this kind of credibility.
Yeah, of course. There are always trade-offs. I mean, private limited companies in the UK, they have to file their accounts
Okay.
at Companies House, which means that, some of your financial information becomes publicly accessible so your competitors can see how you're doing.
Okay.
Selling shares can be more complex because often you need to get agreement from existing shareholders.
Yeah.
And then there are some kind of more stringent legal and administrative obligations
Right.
involved in setting up and running an LTD, more kind of complex reporting requirements, that kind of thing.
Yeah.
And of course, shareholders in a limited company, generally, they expect a return on their investment. So
Right.
they want to be paid dividends, which are a share of the profits.
Right. Right.
So there are those things to consider.
So, yeah, a bit more of an administrative burden. You lose a bit of that financial privacy in exchange for that really important limited liability
Yeah,
and enhanced credibility.
that's right.
Now, the example that we've got in our notes, Virgin Atlantic, the UK arm of IKEA, JCB, Innocent Drinks, I mean, these are all pretty big, well-established businesses.
Yeah, yeah.
Often with, quite significant capital investment. So let's go to the next level now, which is the public limited company, the PLC.
Okay.
And how is that different from an LTD?
Okay, so a public limited company, it kind of builds on the foundations of an LTD, so you still have that fundamental benefit of limited liability for the shareholders. But the key difference, and it is a really big one, is that PLCs can offer their shares for sale to the general public,
Okay.
typically through a stock exchange.
Right.
And this ability to publicly trade shares, that's how PLCs can raise such huge amounts of money,
Right.
which they need for things like major expansion or acquisitions or just making other really big investments. And this process of kind of moving from a private company to a public company, we call this flotation, or sometimes it's called an initial public offering, an IPO.
Right. So going public is basically,
Yeah.
it opens up the potential for, really massive amounts of investment.
Yeah.
What are the other advantages of operating at that kind of scale?
Well, I mean, as you said, being able to raise that much capital so quickly, that is a massive advantage. And the shareholders, they still enjoy that limited liability.
Okay.
PLCs also generally tend to have a much higher public profile,
Okay.
and a kind of greater degree of prestige, just by virtue of being listed on a stock market.
Right.
And that increased visibility in turn can often make it easier to obtain loans
Right.
from banks and other financial institutions because,
Seen as more.
they can see how well you're doing.
Yeah.
So yeah, typically PLCs, they're the right structure for really large, well-established businesses that
Right.
need substantial capital to fund ambitious growth.
Right. So we're in the realm of the corporate giants now.
Yeah, pretty much.
What about the downsides of kind of operating in this very public way?
Well, setting up a PLC is a very expensive and complex undertaking.
Right.
The flotation process itself can involve huge costs, um, legal fees, regulatory filings, and so on,
Okay.
and lots of quite stringent legal requirements as well. And the original owners, quite often, they'll find that they lose a significant degree of control over the company
Right.
because ownership becomes much more dispersed amongst a larger number of shareholders.
Okay.
There's also a huge amount of public scrutiny,
Right.
much more demanding reporting requirements, more regulations, and so on.
Yeah.
There's always the risk of a hostile takeover
Uh,
if another company manages to buy enough shares to take control.
Okay.
And then also, there's constant pressure from shareholders to deliver consistent profits,
Yeah.
which can sometimes lead to businesses kind of, prioritizing short-term gain
Yeah.
over their long-term strategy.
Right. So very different world in terms of kind of pressures and complexity. And the examples we've got here, Tesco, Barclays, Vodafone, I mean, these are really, really big familiar names in the UK. So it makes sense that they would operate as PLCs.
Yeah.
Okay, our final category of business ownership is a bit different because it's got different aims
Yeah.
than not-for-profit organizations. And these aren't primarily driven by kind of, generating profit for owners, are they?
No, that's absolutely right. Not-for-profits, they operate with objectives that are not focused on generating profits to
Right.
distribute to owners or shareholders. So any surplus income they do generate is generally plowed back into organization
Right.
to further their stated mission and goals. And this broad category, this includes both charities and social enterprises.
Okay.
Charities typically rely on donations from individuals, from corporations, from governments to fund their activities
Yeah.
and achieve their aims. Social enterprises, on the other hand, they will aim to generate an income through selling goods or services.
Okay.
But their prior purpose is still to create some kind of positive social or environmental impact.
Right. Okay. So it's that shift from kind of like financial return to a sort of broader societal or ethical purpose.
Yeah, yeah.
What are the advantages of operating in this way?
Well, I mean, they often have a big advantage in attracting volunteers.
Okay.
People who are really passionate about the mission, and they can also be very successful at attracting donations
Yeah.
from individuals and organizations who kind of, align with their aims. And generally they benefit from a very positive public image, which helps their reputation and helps them, get more support from the community and other stakeholders.
Right. Okay. What about the challenges that they typically face?
Well, I mean, funding can be an ongoing challenge, often leading to some degree of instability
Right.
because they're reliant on, external donations or reinvested surpluses, which can be kind of unpredictable
Yeah.
in some types of not-for-profits, such as, say, cooperatives or some types of social enterprise, where they really prioritize stakeholder consultation.
Okay.
The decision-making process can sometimes be a bit slower and more complex.
Makes sense.
And they're also still subject to regulation and scrutiny,
Of course.
to make sure they're operating ethically and transparently. And the examples we've got here, Oxfam, Save the Children, The Big Issue, I mean, they're very different organizations.
Very different. Yeah.
But they all operate under this broad umbrella.
Yeah. So that central focus on mission, brings a very specific set of rewards and challenges,
It does.
particularly around that, securing the funding
Yeah.
and making sure you're on the right side of the regulations.
Yeah.
Okay, well, we've looked at all these different types of ownership structure.
Yeah.
If someone's trying to decide which one's right for them,
Yeah.
what are the key things that should be influencing their decision?
That's a really, really important question for anybody, starting a business or growing a business.
Yeah.
There's several key factors that you've got to think about, I think. Firstly, what level of personal financial risk
Okay.
are the owner or owners willing to take on? So that links back to this concept of liability that we've talked about quite a bit.
Yeah.
How much capital does the business realistically need?
Okay.
to get started and then to achieve its growth ambitions. Because as we've said, the different ownership structures, they have different capacities to attract investment.
Right. Yeah.
Then there's the question of how much control do the owner or owners want to keep
Okay.
over the business and its operations. And then, what's the intended size and complexity of the business? A larger, more complex business might, need the formal structure of a limited company.
Okay.
What are the long-term objectives? Some structures are much better suited to scaling up than others.
Right.
How much do the owners value privacy in
Yeah.
terms of their financial information? And then finally, what are the specific legal and administrative requirements
Right.
and the tax implications of each structure?
Right.
So ultimately, it's about finding the right balance between all these, interconnected factors.
Yeah. Sounds like a really personal and a very strategic decision.
It is, yeah.
Okay, let's just do a quick recap of some of the key terms that we've encountered,
Okay.
just to make sure everyone's really clear on what we've talked about.
Yeah, good idea. Okay, so a sole trader, that's a business owned and operated by just one person who has unlimited liability for the debts of the business.
Okay.
A partnership, that's two or more people
Right.
who agree to own and run a business together, and typically they also have unlimited liability.
Right.
Limited liability, this is the important legal principle that protects the personal assets of the owners of a company from the company's debts. Unlimited liability, as we've discussed, means that, you are personally liable for the debts of the business.
Right.
A private limited company, Ltd, is a separate legal entity owned by shareholders who have limited liability, and the shares can't be offered to the public.
Right.
A public limited company, PLC, also offers limited liability to its shareholders,
Yeah.
but it can offer its shares for sale to the public on a stock exchange.
Right.
A shareholder is just an individual or an entity that owns shares in a limited company.
Right.
A dividend is a payment made to shareholders out of the company's profits.
Okay.
Incorporation, this is the process of registering a business as a separate legal entity, giving it a distinct identity from its owners. A deed of partnership is the legal agreement between partners that sets out, the terms and conditions of the partnership.
Right.
A not-for-profit organization is one that, as we said, operates for objectives that aren't primarily about making a profit.
Okay.
A charity is a specific type of not-for-profit that's set up for, charitable purposes. A social enterprise is a business that aims to achieve social or environmental goals, and it reinvests its profits
Okay.
to further its mission. Flotation, this is the process by which a private company becomes a public company
Right.
by offering its shares to the public for the first time. And then finally, a stock exchange, this is simply the marketplace where the shares of those publicly listed companies are bought and sold.
Okay, phew.
That was quite a lot, wasn't it?
It was a lot.
A lot of terminology.
Yeah. Really helpful, though, to wrap up. What would you say is the single most important takeaway for our listeners about all this, about these different structures?
I think the absolute key thing to remember is that choosing your ownership structure,
Yeah.
that is a really fundamental decision. It's not something to be taken lightly, and it has, significant long-term implications for your business.
Right.
It affects everything. It affects the level of financial risk you're exposed to. It affects your ability to raise capital. It affects how much control you have. It affects your administrative responsibilities, all that kind of stuff.
Right.
It's really, really important to get it right.
And all the structures that we've talked about today, the sole trader, the partnership, the Ltd, the PLC, the not-for-profit, they all come with their own advantages and disadvantages.
They do.
And the key is to weigh those up really carefully.
Yeah.
Think about the needs of your business and also think about your own appetite for risk.
Absolutely. Yeah.
Okay. Well, that brings us to the end of our deep dive into this really fascinating world of business ownership.
Yeah.
Thanks for coming on the journey with us.
It's been a pleasure.
Really appreciate it.
And thinking about these different models, it makes you think differently, about the businesses we interact with every day.
Yeah.
What kind of structure underpins their operations, and how might that be, driving their choices, their strategic choices and their impact on the economy, on society.
Yeah. It's a really interesting point.
It is, yeah.
It does give you that extra layer of kind of understanding.
It does. It does.
Yeah. Okay. Well, that's all we've got time for today. Thanks for listening.
Cheers.